Hey traders, welcome to another global macro update. We're going to be going over a bunch of different asset classes today. But first, we just wanted to go over a few news stories that I found interesting on this search for some relevant news topics of the day. So first thing we're going to look at is the fact that retail everyday traders using things like Robinhood were actually able to do better overall compared to the billionaire investors on Wall Street. So retail investors capitalized on the market comeback, unlike the billionaire hedge fund managers who said stocks would retest their lows. So smart money is not always right, and I just wanted to explain that a little bit further. I personally was pretty short bias and took a couple short positions, both negative for the S&P, so I definitely was in the boat that the market would test its lows or at least have another aggressive move to the downside, especially when that economic data was coming out. But initial job loss claims, GDP contraction did not phase the market really at all. And then we're basically at almost new highs, if not hitting that all-time high pretty closely. So we'll get into that, but it's pretty interesting to see what played out in reality versus the hypothetical situations that we were trying to create in order to get a good trade going. But hey, people lose all the time, and you just got to eat it and not take it too personally. Next thing we're going to be looking at is the unemployment number of 13.3 in May. You know, definitely it was surprising to say the least, and we'll get into that a little bit sooner here. So a lot of people were surprised that it was this high. They thought it would be it was this low. They thought it would be higher in terms of the people unemployed, but we'll get into that right now. So, first off, a lot of people think it was not really real. Nobody believes the unemployment rate in the U.S. fell to 13.3 in May and reflects the true state of the labor market. Not even the government bean counters who came up with the numbers. So what is the real job loss rate? Well, no one knows for sure, given the unprecedented scale of economic destruction caused by the pandemic, but economists are guessing close to 20%. And we can see that the estimated Great Depression peak was at 25 or just under. So what happened? For starters, the Bureau of Labor Statistics said that unemployment rate likely would have been 3 points higher had all the household surveys answered the government's monthly questionnaire correctly. Some respondents who've been temporarily laid off or furloughed due to the pandemic has continued to list themselves as employed but absent from work. Without getting too technical, workers who were furloughed and did not get paid should have classified as unemployed. So in a nutshell, that's kind of what happened, and a lot of people are looking at some of the initial claims, some of the unemployment numbers, and really jumping on the huge bullish rally that we've been saying, and it's happened, and really climbing on the bull run. So I'm a little bit skeptical. I'm not really into the equities just yet. I'm going to hold off, but I know some people who are all in, thinking that this is the absolute best time to invest, which I theoretically do not think that's really the case. So let's now jump into some of the charts here. We're first going to be looking at some major indexes. So first thing, let's look at the world index. This is going to be VT, Vanguard Equity Index Fund, for the total world. So we are making, obviously, a significant move to the upside after our huge bear push down back at the start of February. And let's just see how far we trace back up in terms of the world index. So we're above the 786, which is an important key level within the fib levels. We see that it was initial resistance, which is now turning into a new level of support. And it is holding right here where we see a strong push to the upside, a pullback, but we're not even getting a candle closure on the daily for a red. We're actually seeing it close green, which indicates that buyers are able to push back the price above the open. So that's pretty bullish in terms of the pullback, in terms of the validation of a new level of support indicated by a previous level of resistance. So definitely overall, risk on sentiment is still very present. I don't really see any hesitation in the overall market just yet. S&P Dow did have a little bit of a slower day today, hitting the 30 to 30 zone, previous level of, let's just draw this in, previous level of support. As we can see, we can even zoom back, but not surprising we did get some level of hesitation, but I do think that we will probably get some level of pullback continue going on as long as the risk on sentiment is continuing to go forward. We do have that recent high at around 34,000 right here, not too far from where we currently are. And if we do start to see a move to the downside with some global investors worrying, we do have that previous level of support, which was a level of resistance, which is now going to act as a nice level of support at around the $3,100 area. So we're in a range here, just tested the resistance, which we can see. And if we just consolidate a little bit here and poke up, that's going to be extremely bullish. But if we start to see some hesitation from the bulls and buyers and get that push to the downside, we do have that $3,100 support for the S&P, something to consider. Or SPX, I should say. All right, now we're going to go into the world indexes, going to look at Asia and Europe. So this red one is going to be Japan. We saw back from 2017 where we were in a range consolidating with not being able to make a higher high or a lower low. Did get a little poke out here, but overall we are seeing a sideways consolidation. Massive sell-off that we got as a liquidation event around the globe, around basically all asset classes. Massive recovery. And that's pretty weak for the yen. This is an inverted correlated instrument compared to the yen. So we do see when this goes up, the yen generally goes down on the larger time frame. So this is pretty bearish for the yen, strong for the Japanese stock market. So we got a key level of resistance coming up. We do still see that there's a decent amount before we actually hit it, although we are right near previous level of support, new level of resistance. Although it's been on an absolute rocket ship recently, not really seeing any major pullbacks. So I wouldn't be surprised if we get some level of consolidation that's going to use this previous support as a new level of resistance. We can also see it back here and back here. So if we extend that a little further, we can see resistance, turn to support. Probably going to be some level of sensitivity for a resistance. But overall, very bullish for the Nikkei 225, which is the Japanese stock market index. Now we're going to go into the FTSE, I believe. This is the DAX. Sorry, the next one is going to be the FTSE. So this yellow one is going to be the DAX, which is the German index. Like we see in Japan, key level of consolidation where we were unable to make a higher high or a lower low, and then got a massive sell-off, and our recovery has just been unbelievable. We're in a bit of a similar situation as to the Japanese market, where we saw a previous level of resistance turning into some level of support. So there's a little bit of hesitation there, but I am going to expect that the prices will continue with the risk on environment in place, pushing this index to the all-time high here, because it does not seem to be stopping. And unless there's some major economic news, I think that it will take a breath and just continue moving towards the upside, chugging along here. DAX is looking pretty strong overall. Let's just quickly see how far it's climbed. It's now gone above the 786, which is pretty important level, and now it's holding for a new level of support. So it's looking pretty good for the DAX on the upside overall, which is the German index. And then the last one's the FTSE, which is the UK index. And let's just see where this is. So this one just got over the 50% and is still under the 61.8. So it's definitely weaker in the United Kingdom index compared to the German or Japanese index, but overall we are still making a move to the upside. Something to consider. This key level was a previous level of, well, initially it was a resistance right here for the reverse head and shoulders, pushed up, made a new support. Probably going to be some level of resistance here when the price is moving up, but as we zoom in and look closer, it is still making pretty aggressive higher highs and higher lows. So the UK looks the weakest out of the three indexes that we're identifying right here, but overall, the risk on environment is still really set in place, and overall global investors are looking for speculative trades and investments more than looking at safe haven currencies, or even at this point looking at precious metals as stores of value. So that's my view of the general market. This is the Russell 2000. This is also a good indicator of how speculative global investors are, because this is a small cap index, and usually when there is more speculation in the market, This is going to appreciate greater than the blue chips that we see within the S&P. And then when it's a risk-on environment, when investors are worried, this will most likely move to the downside more aggressively than the blue chips like the S&P 500. So it's a good way to understand the more speculative investors in the market. And then the S&P would be like the big kahunas and kind of largest caps in the United States, which is obviously the head of capital markets, really. So that's going to be the equity analysis globally. We looked at the world stock index. This is Europe and a little bit of Asia. We don't really have much other than Japan. And then we looked at some small caps. So now let's look at some other assets. So we are first going to be looking at Brent and WTI Crude. So WTI Western Texas Intermediate, and then Brent Crude, very similar chart. They're from different places. You can look at what the differences are if you'd like on Google. But in terms of where they're going, crude oil is still moving towards the upside. It broke a key level of resistance at around $40, and it's now held that previous resistance for a new level of support. And we're seeing our next 12-hour candle and 6-hour candle come with some decent buy volume in the market, which is, in my opinion, signifying that the bulls are still in control and have confidence to push the price higher and higher. So that is good for things like the Canadian dollar, the Australian dollar, and other risk on currency pairs as well. So that's just something to note. And also we do see that the US government bonds for the 10-year and 30-year are going down as well. So there's less demand for bonds. Obviously, bonds are an instrument that investors look at and use in times of uncertainty and economic turmoil. So the fact that these bonds are going down in yield indicate that there is less demand for these bonds, which obviously would be an overall pretty good thing for the risk on bias that we are cultivating and creating within our trading plan. So that's the overall market in terms of the different instruments that we're looking at, just to get a gauge of either we're in a risk on or risk off environment. Also, fear and greed index is a little bit more weighted towards the greed side than fear, but overall it's generally neutral. So we'll take a look at that to complete the risk on, risk off analysis, because that's going to create our bias, our longer term bias. And you can see back 1 month ago, pretty significant fear. 1 week ago, greed, and we're now increasing here in the greed. And this just looks at some put call options, safe haven demand, stock price breadth, and market volatility, all this stuff. So basically, this is just a good gauge for a quick understanding. And I'm in the same boat. I think it's more of a risk on environment where investors are able to take a little bit more risk on because they're optimistic about the future, which in my opinion is a little bit crazy, but got to trade the price action, got to trade what the charts show you, not what your bias is. And that's what we're trying to do right now. So that's the overall market in terms of the bonds, in terms of oil, some commodities thrown in there, and the equities market. So we're now going to go into gold, silver, and the gold and silver ratio to get a good understanding of where the safe havens are within this market. So we do have to understand that due to it being a risk-on environment, we could see a little bit of hesitation in gold and silver, which are primarily used as stores of value and stores of wealth in uncertain times when CPI numbers are going and inflation numbers are going up. You're going to start to see people put their money in gold. But right now, we're not really seeing that. There is deflationary pressure, obviously, with the velocity of money decreasing. And overall, we are seeing not a lot of CPI numbers increase. So let's just quickly look at those CPI numbers to decide. Let's just do CPI globally, because this is going to be a good gauge of inflation. If CPI numbers are increasing substantially, people are going to be looking at gold and silver. But overall, there's deflationary pressure due to the velocity of money, due to the inactivity of the economy. Buyers and sellers exchanging currencies is slowed down, and that's basically going to slow down the push of inflation that central banks are trying to promote. So we see inflation monthly basis. If it's negative, it's deflationary. If it's positive, it's inflationary. And most central banks want like 2-3% inflation on a year-to-year basis. You can see, let's just check the big ones here. Canada, negative 0.65, and we have we have deflationary pressure on a yearly basis. Let's just look at Germany. They got a little bit of inflation with some positive CPI numbers. We got, let's just look at, let's do United States, negative inflation, negative CPI numbers, which is deflationary. The velocity of currency is going down substantially. Transacting goods and services decreasing as well. So overall, pretty good for the dollar, pretty strong for the dollar, and we're not seeing that much inflation worries. So there's not going to be a massive run to gold and silver yet, especially because it's a risk-on environment. Equities are doing well. There's no real major need to go into gold and silver in the immediate short-term time frame from global investors' viewpoint and my personal belief. So I think that gold could stall and consolidate here for a little bit longer. We do have a potential squeeze coming into fruition. We had a small one, which I did not enter. I was just looking at it. We got initial touch point, 2 touch points right here. We're looking for a third to create our structure for this resistance, and we had 1 resistance turn into 2, 3, 4 support. We were looking for support right around here with this resistance, support, support, support. There's going to be a key level of demand here, and it did push up, which was great to see. I was not really looking at that just because it's in a pretty difficult zone, and with equities are up and it's a risk-off environment or risk-on environment, I was remaining a little bit hesitant because let's just make this a little bit bigger just so it's easy to understand. We were looking at this squeeze initially right here, and we did poke to the upside, which was good to see. I'm a little bit hesitant on entering because the risk reward is not great, because the next resistance is here. That's going to be basically your take profit. You could be looking at a risk here, and then your entry could have been there. So like maybe 1.75 or 2 to 1. I don't really like to enter trades unless you got a 2 to 1 or greater risk reward. I just wouldn't enter it. So that's currently what I see in the market. I'm going to wait a little bit further because I still see that expanding zone. And we can get a little bit more volatile here as we get deeper into the pattern. And it's not something I really want to do. So I'm going to let it do its thing. I'm going to keep an eye out for it. That's what we saw. And we're getting a move to the upside. And I think that we could continue to go kind of slowly making the way down, making lower lows and lower highs until we get some fundamental factor that is going to create a little bit more incentive for people to look at gold and silver. And if it does move to the upside, maybe hit this one more time. We got 1, going to call this 2, and we got 3, and they got either type A or type B touch on this rejection point. That would be enough for me to validate a potential breakout. If it does break this lower high, make a higher high, we're looking for a higher low to hold the previous resistance, which is going to be a new level of support in confluence with a potential horizontal zone for a new level of support as well. That is going to be what we're looking for a potential entry. So we got a little bit of time before we have that in place. So I'm just going to sit and not really get into gold, because in my opinion, it's not at a position which allows me to have a good edge in the market. So I'm just going to wait it out and stay patient for a good structure that allows me to play my edge to my advantage. All right, so this is silver. So let's just take this off and discuss what we can currently see on the 4-hour time frame. And let's just take our picture here. And same thing with silver as we talked about for gold, in that it is currently a risk-on environment. People are looking at equities, emerging markets, in terms of currencies, small caps, more speculative investments to make more money, because investors are optimistic about the future. They're optimistic about the future gains that they'll potentially make from the risk that they're taking on. And we're not seeing that much risk on sentiment at all in the market. So overall, silver wouldn't be an extremely bullish situation just in terms of the current world sentiment, in my personal opinion. So we will be looking at gold and silver in that viewpoint until we get a shift in trend and a shift in sentiment. So we got huge moves. We got our initial $14.50 to $15.05. And then we got a nice squeeze right here. That was really poorly drawn. And then we got a nice squeeze right here. made a consolidation on the previous resistance as a new level of support and absolutely rocketed to our next key level of resistance right here. And then we made another squeeze with a descending zone and an ascending zone, another huge push to the upside. And those are two massive pushes. If we zoom out a little bit, look how much work that this did. A massive push-up consolidating, strong push-up consolidation, strong push-up consolidation, strong push-up consolidation. It's completely normal. It is just how the market takes a breath. And right now, there's not much to do in the market, which in my opinion is totally all right in terms of the metals. Now we are seeing consolidation hold the previous confluence zone from this resistance, which is now turning into a new level of support and confluence with the ascending support that we created for this symmetrical triangle setup. So the support is going to be right around here, but I'm patiently going to wait until gold does something interesting. Silver could be a front runner. Totally, that could be something that could play out. But in terms of the current structure in the market, I don't really love what I'm seeing right now. I do see a potential reverse head and shoulders. If you see that on the 1 hour time frame, you see that this was the major head right here. This was the left shoulder that held. This could be the right shoulder, and this 1780 zone is a key level breakout that we are looking for this potential reversal pattern. So let's just draw in so everyone understands how clearly labeled it is. Left shoulder, pullback, head, pullback, right shoulder, pullback. So all we're looking for is a higher high and a higher low to hold the previous resistance as a new level of support. And when we have that, maybe we see a candle with a wick. That is a really good indication for this reverse head and shoulders pattern. Like I said before, I'm going to be a little bit hesitant just because of the fact that gold's not really doing well. It's just consolidating sideways. We do see a high, lower high, lower high, lower high, lower high, lower high, lower high. I'm going to try to draw a trend line, but it is, in my opinion, a little bit messy in terms of where it is. So I'm going to be a little bit hesitant and really careful to make sure that we're not entering on something that's just going to consolidate sideways here. We want to enter on really good structures that are aligned with the overall sentiment of the market and with the risk on environment, with gold kind of consolidating, and we'll get into the gold and silver ratio later. Something that would really need to show me that like a huge bullish engulfing candle, massive wick to the downside with the candle body really just at the top with a long wick down, indicating the buyers are able to push the price right back up. That would be something that I'd be interested in, but until that happens, or gold does something that is a little bit more interesting, I'm going to hold off and just let the price action consolidate until I get a better structure to trade with. And then looking at the gold and silver ratio really quickly here, we have held our weekly ascending support, which was a previous level of resistance on our ascending zone. You can see that right here. And we thought there was going to be some interaction within this zone, which there definitely is. And right now on the 2-day chart, we're just consolidating. Doesn't mean that it's super bullish for gold, but the fact that this is consolidating means that there's not a huge move that's coming up. What we're looking for is kind of what we got from like April and onwards, where the gold and silver ratio was going down. Gold was doing decent, but silver was absolutely exploding. So if this moves to the upside, it could be better to look at gold in the short term in terms of swing trade opportunities. But as long as this is carrying its momentum to the downside, we will have market breath. We will have consolidations where the market has to stop, have a little bit of a bull rally. That's just how the market operates. It's not going to go from point A to point B in a single straight line. That's just not how it works. You got to have these corrections, and that's currently what we're seeing right now. So if we do see a little correction and then we start to see maybe like a wick like here with a long wick to the upside and then a bullish hammer or bearish hammer candle closure, then we could start to see that momentum to the downside again, which would be bullish for silver. Not like it's not bullish for gold, but it's just extremely bullish for silver. So that's the overall market analysis in terms of the metals and equities. So that's going to be my global macro update for the day. Not really going to get into currencies or anything, and I will do another one for crypto, but that's going over equities, going over metals, the safe havens, the stores of value, and then looking at some other instruments that are giving some level of analysis as to the broader sentiment of the market. Looking at oil, that's a key one. Looking at T-bonds, treasury bonds from the United States, that's also a pretty important thing to look at as well. So overall, risk-on environment, we're looking for longs, we're looking for pairs that are definitely more in the discrepancy between risk on and risk off, like we see the Australian dollar versus the US dollar. US dollar is a major risk off currency, Australian dollar is risk on, New Zealand's a risk on, Japanese yen is a risk off. So you're looking for that large discrepancy to get that strong move either to the upside or downside depending on what you're trading. And overall, the cryptocurrency market is very, very tight in consolidation, not seeing much volume, contracting in volatility. We did get a pretty big move up and a move down back in June 8th, which was yesterday, but it held the support and it's slowly climbing up, not really doing a whole lot. So a little bit of a boring Monday and a little bit of a Tuesday, but that's going to be how it is. You're not going to trade every single day. You shouldn't really be trading every day unless you're day trader, but even then, we really got to practice patience. So hopefully you enjoyed it. If you have any questions, drop them in the comment section below. If you found this educational, helpful, useful, entertaining, it'd be great if you would subscribe to our YouTube channel, and you'll get more videos like this informing you of the overall sentiment, some global macro indicators that we are looking at, some news catalysts or news blog posts that have some relevance to the market. So hopefully you enjoyed it. Until next time, have a good one, traders.